Hi traders, I just want to bring your attention to a medium to long-term long on the US dollar versus the South African rand. Just looking at the close of last month, we have the close of a bullish pin bar reversal on the monthly chart. And I know you're probably thinking, wow, the monthly chart, well, this is long-term. But the state of affairs in South Africa is actually quite interesting, apart from being quite upsetting. What happened, certainly in the news, which has caused price action to give us this technical setup, is that President Zuma has dictatorially fired his head of the Treasury, Pravin Gordhan, and a bunch of his associates. And this has been done in a thoroughly dictatorial fashion, and this has sent investment or investors into a state of panic in South Africa. And certainly you could reasonably conclude that where there is not investor confidence, you can expect a lot of volatility and the flight to safety. So what does this mean for the US dollar versus the South African rand? Well, looking at the United States versus South Africa from a geopolitical standpoint, as well as an economical one, we can reasonably say that the US is, compared to the recent events in South Africa, a much safer place for money to be invested, relatively speaking. And of course, you've got the stability, or relative stability as well. So that's the fundamental argument supporting a potential medium to long-term long. Let's look at the technical one. Okay, so last month, just turned March, we had the close of a bullish pin bar reversal, which is a bullish sign, of course. A bullish pin bar reversal, for those of you who don't know it, is basically where we've got the open and close in the top half of the bar and the tail just below. That's a sign that we've tested a price extremity and the bears have not been allowed to penetrate further down. The bulls have come rushing into the market to cause it to close as this bar with the long tail. So it's a sign that price has been tested, but it hasn't been allowed to hang around or penetrate deeper. It's just shy of 12 here. And if we look at the fact that it's a bullish pin bar reversal and the fact that we are also coming off a major Fibonacci retracement level, let's just get the Fibonacci retracement up from here. And then we can just draw it all the way from 2012 to the most recent. You can see that this bullish pin bar reversal has just eclipsed, or just come shy of the 50% Fibonacci retracement, which is a valid level. It's essentially halfway to the high last seen here back in December 2015. We've seen the retracement. A lot of long, medium and short-term trends typically after the initial surge retrace back 50% of the way prior to a continuation. So could this be the continuation for the US dollar strength against the South African rand? Well, who knows, but the clues are there. What is more telling as well is the fact that we've rejected the 50 and we've just come shy of this previous spike here. Okay, so could this just be a bull flag? Well, we haven't quite got the bullish reversal on the daily time frame or the smaller time frames because of the news that came from Johannesburg, or Pretoria should I say. It was a very sudden shock and the movement was very quick. Obviously, we've seen an upward trend on the shorter term time frames, but if we look at it from a long term point of view, this does look pretty bullish given the close of last month and the point to where it's retraced. So you could be asking yourself now, okay, well, where's an efficient point for entry if we're going to go long on the US dollar versus the South African rand? Well, there are two options you can have, okay? Each have pros and cons. You can either take the break of last month's high with your stop loss below last month, i.e. March's low, or you could do something which a number of traders will do, and that's simply wait for a more efficient entry. And when I say a more efficient entry, I'm simply referring to price potentially going down a little bit further so you can essentially get better reward to risk. Because if you think about it, if our entry is here and our stop loss is here, and our first target is all the way up here, then we're going to have to wait roughly about roughly about a 3 to 1. Okay, so distance between entry and stop loss here fits into distance between entry and target 1 up here 3 times. But if, say, for example, you've got a little bit more of an efficient entry and trade this one as an advanced pin bar reversal and had your entry halfway down the bar like so, anticipating things getting, well, the US dollar weakening before it strengthens again against the South African rand, then you could wait to catch it down here at the midpoint of March with your stop loss below the low. That essentially doubles your reward to risk, okay, because you've halved the distance between your entry and your stop loss. So it does double your profit potential in that way. But the downside is, of course, that the market might just not come back to that point and it might just go without you. And the conventional entry is the safer entry. Like if we entered at the break of last month's high, stop loss below last month's low, then that is, like I said, a conventional entry and a safer one, because of course it relies on the fact that the high of the setup bar has been breached, that there are bulls there willing to put their head above the parapet, as it were. So how you trade this is entirely up to you. I'm going to be watching this very closely over the next couple of days or weeks, but ultimately I think it is really a one-way direction when you look at the fundamentals, with certainly South Africa and the downward spiral of the ANC and of course President Zuma, who's really not doing himself any favours. Okay, so we've got technical bullish bias as well as a fundamental one. Okay, so that is the US dollar versus the South African rand. Happy trading.